Hello, everyone. December 23rd, 2025, 11:47 p.m. Eastern Time. While you're watching this video, something extraordinary is happening in Shanghai. Silver just closed at 71.54 per ounce. That's not remarkable by itself. Here's what is. In New York, at the exact same moment, silver is trading at that's a $253 gap. Now you might think, different markets, different prices, no big deal. Except this gap shouldn't exist. For decades, arbitrage traders have made fortunes eliminating these differences. Buy cheap in New York, sell expensive in Shanghai, pocket the difference. It's automatic, it's mechanical, it happens within hours. But right now, in December 2025, this gap has been widening for weeks, and money that should be flooding in to close it, the billions in arbitrage capital that should be equalizing these prices, it's not coming. The bridge is broken, and when I show you why, when I show you what's actually happening in the physical silver market right now, you'll understand why some of the smartest traders in the world are saying that $73 per ounce isn't a target. It's already the truth. The Western paper market just hasn't admitted it yet. Let me show you something that should be impossible. The Shanghai Futures Exchange and the COMEX in New York both trade silver, same metal, same purity, same global market. For years, if Shanghai traded at a premium, arbitrators would buy COMEX contracts, take physical delivery, ship the metal to China, and sell it for profit. This kept prices aligned within $1 or $2, accounting for shipping costs, insurance, and China's 13% of V8. That's how global markets work. Supply flows to demand, prices equalize. Basic economics, it's not working anymore. As of December 22nd, 25, Shanghai silver closed at 71.54 per ounce. COMEX spot price at the same time, 69.57. That's not a temporary blip. That's a 2050-30 structural premium that's been persistent for weeks now. 3 weeks ago, it was 196. A month ago, it briefly went negative, then snapped back. Now it's widening. And here's what the financial press isn't telling you. This premium should not exist if Western vaults have silver to deliver. If COMEX registered inventories were flushed with metal, traders would be draining those vaults right now, shipping to Shanghai, collecting the premium. It's free money, but they're not. And the reason why it changes everything you think you know about silver pricing. According to the latest vault reports from the Shanghai Futures Exchange, inventories dropped by 1,101 ounces on December 18th alone. The Shanghai Gold Exchange, which also tracks physical silver, reported outflows of 28,000 kilos in a single week. That's nearly 29 tons of silver leaving vaults heading into industrial consumption or private hands. Meanwhile, COMEX eligible silver inventories have been bleeding. In early December, over 60% of registered silver, the metal actually available for delivery, was claimed in just 4 days. And here's the number that should alarm you. COMEX currently holds approximately 280 million ounces in total inventories, but only a fraction of that, around 100 million ounces, is registered for delivery. The rest is eligible, meaning it's stored there, but not committed to any contract. Now compare that to open interest. There are active futures contracts representing over 900 million ounces of silver on COMEX. That's 9 times more paper claims than there is registered physical metal. If even a small percentage of those contracts demand delivery, the system breaks. And the Shanghai premium is telling you that's already starting to happen. Now, here's why this matters to you right now. Because China isn't just any silver buyer. China consumes over 25 to 30% of global silver production. And in 2025, their demand exploded. The Chinese solar industry alone consumed an estimated 99 million ounces of silver this year. That's 6,200 metric tons. Electric vehicle production added another 2,066 tons. Electronics and electroplating, another 4,000 tons. Put it together, and China's 3 main industrial sectors consumed over 12,566 tons of silver in 2025. That's 404 million ounces. And here's the critical part. This demand is inelastic. Let me explain what that means. Inelastic demand means the quantity purchased doesn't change significantly even when prices rise. Why? Because the alternative is worse. Imagine you're a factory manager in Guangdong province. Your solar panel production line it runs 24 hours a day producing panels for export to Europe and the United States. Your line requires silver paste for the photovoltaic cells. Without that silver, your entire production line stops. Now, silver prices have jumped from $30 an ounce earlier this year, nearly $70 today. That's more than doubled. Do you shut down production because silver got expensive? No, because every day your line is offline, you lose millions in revenue, millions in contracts, millions in penalties for late delivery. So you pay the premium, you hit the bid, you buy silver at 71, 72 or $73, whatever it takes. Because a $2 premium on silver is nothing compared to a $50 million production shutdown. And that's exactly what's happening in Shanghai right now. Chinese manufacturers are buying physical silver at premiums over Western prices because they cannot afford not to. And when millions of ounces of demand hits a market with thinning inventories, prices don't drift higher, they gap. This brings us to the second piece of evidence, the paper versus physical fracture. For decades, silver prices have been set primarily by futures contracts on COMEX. These are paper contracts. Only about 1% of them ever result in physical delivery. The rest are settled in cash, rolled over, or offset by opposing trades. This system allowed for massive leverage. Banks, hedge funds, and speculators could take positions representing hundreds of millions of ounces without ever touching a single bar of silver. And critics have long argued that this paper market has been used to suppress prices. Whether through legitimate hedging or outright manipulation, abundance of paper contracts kept a lid on physical prices. But in 2025, that dynamic is breaking. Here's the proof. On Monday, December 22nd, Western trading hours, silver opened near $67.50. In early trading, there was heavy selling pressure. Analysts described it as coordinated, large volume, aggressive shorts, the kind of selling that in previous years would have smashed the price down by 3, 4, 5% in a matter of hours. It's happened before. Silver bugs call them smash attempts. Sudden paper selling designed to break bullish momentum, trigger stop losses, and scare retail investors out of positions. Except this time it didn't work. Silver dipped briefly to reversed. By the end of the day, it closed at 68, fallen 70.40 on less than 9%. Volume was heavy, over 74,000 contracts, well above average. And overnight, as markets opened, silver pushed even higher. Shanghai ignored the Western selling entirely. They kept buying physical and the premium widened. That's the fracture. Western paper markets tried to push prices down. Eastern physical markets said no. And when physical demand overwhelms paper manipulation, the paper market loses. It has to, because you can't deliver paper to a solar panel factory. You need the actual metal. Now, let me show you the third piece of evidence, and this one is mathematical. It's called thin liquidity velocity. Silver is a relatively small market compared to gold or crude oil. Total above ground silver inventories are estimated at around 1 fee to 2 billion ounces globally. But most of that is locked up. It's in jewelry. It's in electronics. It's in industrial applications where it's effectively consumed and not recoverable. The free float, the amount of silver actually available for trading and investment is much smaller. Estimates vary, but analysts suggest somewhere between 200 and 400 million ounces are truly liquid at any given time. Now, when a large buyer enters this market, say a Chinese manufacturer needing 1,000 tons for a solar panel contract, that's 32 million ounces. They have to source it from the available supply if sellers are scarce, like if vaults are low, if lease rates are spiking, indicating nobody wants to lend their silver, then prices don't move gradually. They jump vertically because there's an air pocket in the order book. There are no sellers at $69, no sellers at $70, and suddenly the next available offer is at 70 velocity. The speed at which price moves when liquidity is thin. And we're seeing it right now. Silver lease rates, the cost to borrow physical silver have spiked to 39% annually. That's unprecedented. In a normal market, lease rates are low, often near zero, because silver holders are happy to lend their metal for a small fee. But a 39% desperation. That's short scrambling to find metal to deliver, willing to pay massive premiums just to borrow it. And when lease rates spike like this, it's a signal the physical market is tight, very tight, And when a large order hits a tight market, the price doesn't crawl, it explodes. So let's put all three pieces together. We have a persistent arbitrage premium between Shanghai and New York. That should not exist. If Western vaults are full, we have evidence that Western paper selling on December 22nd failed to suppress prices because physical buying overwhelmed it. And we have thin liquidity combined with spiking lease rates indicating the available supply of physical silver is extremely limited. Now, here's the question. If all of this is true, if the physical market is this tight, why isn't silver already at $80, $90, or $100 per ounce? And the answer is because the paper market is still functioning. COMEX futures are still trading. Banks are still writing contracts. The system hasn't broken yet, but it's cracking. And the cracks are widening because every week more physical silver flows from west to east. Every week COMEX inventories drop a little more. Every week industrial demand consumes another 20 million ounces. That's not coming back. And at some point, the paper market will no longer be able to deliver if called upon. At that point, the price discovery mechanism shifts entirely to the physical market. And when that happens, the price will no longer be set by speculators on a screen in New York. It will be set by manufacturers in Shanghai, willing to pay whatever it takes to keep their production lines running. And that price, according to the evidence we just walked through, is not $73, maybe higher. Now, I know what some of you are thinking, and this sounds like conspiracy theory. Silver manipulation, Eastern versus Western markets, hidden shortages. Where's the proof? So let me give you the receipts. Let's start with supply and demand fundamentals. The Silver Institute, the international trade organization that tracks global silver markets, released their 2025 outlook, and it projects that 2025 will be the fifth consecutive year of structural supply deficits. That means demand exceeds mine supply, not by a little, by approximately 200 million ounces per year. Over the past 5 years, cumulative deficits have exceeded 800 million ounces. Now, where does that silver come from if mines aren't producing enough? It comes from above ground inventories. It comes from vaults. It comes from ETFs. And those stockpiles are being drawn down year after year. Global mine production of silver is roughly 800 to 50 million ounces annually. And that number has been flat for over a decade. The easy silver has been found. New mines take years to develop. Existing mines are depleting. Meanwhile, industrial demand in 2025 is estimated at 1.2 billion ounces. Solar panels alone consumed over 300 million ounces this year. Electronics, another 250 million. Electric vehicles, 80 million. Add in jewelry, silverware, coins, bars, and investment demand, and you get a total demand number that far exceeds supply. The only way the market is balanced is by draining inventories, but those inventories are finite and they're running low. That's not speculation. That's published data from the Silver Institute, from the World Silver Survey, from exchange reports. It's all public. You can verify it yourself. Now, let's talk about China's specific role. According to the National Energy Administration of China, solar panel installations in 2025 reached record levels. 240 gigawatts of new capacity were added. Each gigawatt of solar capacity requires approximately 800,000 ounces of silver. Do the math. That's 19.2 million ounces consumed by Chinese solar installations alone in 1 year. And 20 to 26 projections are even higher. China has committed to carbon neutrality by 60, which means solar build-out will continue at this pace for decades. But here's the problem that silver is gone. It's not coming back. Solar panels have a 25-year lifespan. By the time that silver can be recycled, it's 2050. Meanwhile, new panels need new silver every single year, and the supply deficit keeps widening. China is also preparing for this. On January 1st, 2020, from now, China will implement new export licensing requirements for silver. Any producer or exporter dealing with more than 80 tons of silver annually will need government approval to ship metal outside the country. Why? Because China is prioritizing domestic supply. They're locking down silver for their own industries. Solar, electric vehicles, electronics. They've seen the supply crunch coming and they're acting accordingly. This isn't speculation. It's official policy. The export controls were announced in July 2025 and take effect in a week. And when they do, the amount of silver available to the rest of the world shrinks further. which means prices outside of China have to rise to attract whatever supply remains. Now let's talk about what happened on December 22nd in more detail, because this is where the evidence gets specific. Monday morning, December 22nd, COMEX silver futures opened at 60.70.55. By 9:30 a.m. Eastern Time, selling pressure intensified. Within 30 minutes, the price dropped to 67.47 sub. Trading volume spiked. It was aggressive, coordinated selling. Traders on forums and social media immediately flagged it as a potential smash attempt. These are not rare. Silver has experienced similar sell-offs before. In 2020 and 2021 and 2023, there have been sudden drops where large volumes of sell orders hit the market within minutes, driving prices down and triggering stop losses. Critics argue these are orchestrated to protect short positions or to shake out retail investors. Whether that's true or not, the pattern is recognizable. But here's what was different. On December 22nd, the selling failed. By 10,000 a.m., silver had recovered to 68. By noon, 68.50. By the close, 68.74, up to 39% for the day. And overnight, as Shanghai opened, the price pushed even higher. Asian buyers didn't care about the Western selling. They bought anyway. Physical demand overwhelmed paper pressure, and that's the key signal. In previous years, when these smash attempts occurred, they worked. Prices would drop 5, 8, 10% and take days or weeks to recover. But now, the recovery is almost immediate, which suggests that physical buyers are waiting on the sidelines, ready to absorb any dip. And if physical buyers are consistently stepping in at these levels, it means they believe current prices are cheap. They're not selling, they're accumulating, and that dynamic buyers overwhelming sellers is what drives prices higher, not gradually, but in surges. Now, let's address the elephant in the room. If everything I'm telling you is true, if the silver market is this tight, if inventories are this low, if demand is this strong, why hasn't the price already exploded? Why are we and not $100 or $150? And the answer is because the paper market is still absorbing pressure. COMEX is still functioning. Futures contracts are still being traded, settled, and rolled over. Most participants are not demanding physical delivery. They're speculating on price movements, hedging risk, or arbitraging spreads. And as long as that system holds, as long as the majority of contracts don't stand for delivery, the paper market can continue to influence prices. But there are limits, and we're approaching them, because COMEX only has about 100 million ounces of registered silver available for delivery. If just 10% of open interest, roughly 90 million ounces, demanded physical delivery simultaneously, COMEX would be in a crisis. They couldn't deliver. They'd have to settle in cash at much higher prices, or they'd have to declare force majeure, essentially defaulting. And once that happens, once confidence in paper breaks, the entire pricing mechanism shifts to the physical market. And the physical market, as we've seen from Shanghai premiums, is already pricing silver higher. It's not at $69, it's at $71, $72. That's the truth. The paper market just hasn't caught up yet, but it will. It has to, because you cannot print physical silver. You cannot create it with a keystroke. And when the paper claims exceed the physical metal by 9-1, eventually someone is going to call that bluff. And when they do, the repricing will be violent. Let me give you some historical context, because this is not the first time a commodities market has experienced a paper physical disconnect. In 1980, the Hunt brothers attempted to corner the silver market. They accumulated physical silver in long futures positions, driving the price from $6 per ounce to over $50 in a matter of months. Eventually, regulators changed the rules, forcing liquidation, and the price collapsed. But here's what's different now. The Hunt brothers were speculators. They were trying to manipulate the market for profit. What's happening in 2025 is not speculation. It's industrial demand. China needs silver for solar panels. Manufacturers need silver for electronics. These buyers are not going to liquidate. They're going to consume. They're going to use the metal. It's gone. And that creates a fundamentally different dynamic. In 1980, when the price collapsed, the silver flooded back onto the market. In 2025, if prices spike, the silver doesn't come back. It's embedded in a solar panel on a rooftop in Beijing. It's in a circuit board in a smartphone. It's consumed. And that's why this time is different. The demand is real. Supply is finite. and the imbalance is structural, not speculative. Another precedent. In 2011, silver reached 48.70 per ounce. At the time, it was driven by a combination of investment demand following the 2008 financial crisis and industrial demand from recovering global economies. The 2011 peak was also accompanied by significant premiums in physical markets. Coin dealers were charging 5, 10, 15% over spot prices. Delivery delays stretched to weeks. It was a physical squeeze similar to what we're seeing now. But in 2011, central banks were still buying bonds. Quantitative easing was just beginning. The dollar was relatively strong, and after the peak, investment demand faded, industrial demand moderated, and the price corrected back to the 20s and 30s for most of the decade. Fast forward to macro environment is completely different. Central banks are no longer net buyers of bonds. Inflation is persistent. Real interest rates, after adjusting for inflation, are negative or barely positive. The dollar, while still the global reserve currency, is facing structural challenges. Federal Reserve balance sheet is bloated. Government debt is at record levels. Deficit spending continues. And in this environment, hard assets like silver are not just industrial commodities. They're monetary hedges. Investors are allocating to silver not just for industrial demand, but as protection against currency debasement. And when you combine monetary demand with industrial demand, both surging simultaneously, you get a price dynamic that's far more explosive than either one alone. Now let's talk about what's likely to happen next, because we're at a critical juncture. The Shanghai premium is widening, COMEX inventories are declining, lease rates are spiking, industrial demand is relentless, and we're entering a period where several catalysts could converge. First, January 1st, 226, China's export licensing takes effect. Any silver producer in China wanting to export metal will need government approval. That's going to restrict supply to international markets. If Chinese silver stays in China, the rest of the world has to compete for whatever remains from other producers. Mexico, Peru, Australia, Chile, but global mine production is flat. There's no spare capacity, so international prices will have to rise to ration demand. Second, Q1 2026 is peak solar installation season in the Northern Hemisphere. Spring and summer are when solar projects ramp up. That means manufacturers will be ordering silver, paste, and other materials in January, February, and March. If inventories are already low and demand surges seasonally, that's another pressure point. Third, the Federal Reserve's next policy decision. If the Fed signals further rate cuts, which many analysts expect given recent data, that weakens the dollar. A weaker dollar makes dollar-denominated commodities like silver more attractive to foreign buyers. It also reduces the opportunity cost of holding non-yielding assets like physical silver. So rate cuts, if they happen, could pour fuel on an already hot market. Fourth, and this is speculative but worth watching, if there's any major geopolitical event, any escalation in conflicts, any sudden crisis that triggers safe haven demand, silver could spike overnight. We've already seen this in recent weeks. Enforcement actions against Venezuelan oil tankers, cyber attacks on energy infrastructure, tensions in Eastern Europe and the Middle East. Each of these events has contributed to silver's strength. Investors see silver, like gold, as a hedge against geopolitical uncertainty. And in late 2025, that uncertainty is high and rising. So any sudden shock could be the match that ignites a much larger move. The fifth, and perhaps most important, the psychological threshold. Silver is approaching $70. As I'm recording this, 70 is a round number. It's a headline number. If silver breaks and holds above 70, it will attract mainstream media attention. It will bring in new investors who weren't paying attention before. And that additional demand, that wave of new capital, could push the market into a parabolic phase. We saw this once silver broke $40, it went to 48 in a matter of weeks. If it breaks 70, the next target is 80, then 90, then 100. And at each level, more investors pile in, creating a feedback loop. That's how bull markets work. Not in straight lines, but in surges punctuated by brief corrections. Now, let me give you the specific price targets based on the evidence we've reviewed. In the very short term, within the next 72 hours, if Shanghai continues to trade at a premium and Western markets catch up, we could see spot silver test 72 That's not a prediction. That's just closing the arbitrage gap that already exists. If New York silver trades at 69 and Shanghai is at 71.54, the fair value is somewhere in between. But given the direction of flows, given that physical is moving east, the Western price needs to rise more than the Eastern price needs to fall. So $72 by the end of this week is plausible. In the short term, the next days, if the catalysts I just mentioned play out, particularly China's export restrictions in Q1 seasonal demand, move to $75 to $80 is realistic. That would represent a continuation of the current momentum. Silver has gained over 34% year to date. A move from 69 to 80 is roughly another 16% in the context of a market that's already up over 100% this year. That's not extreme. It's a continuation in the medium term. The next 3 to 6 months, if physical tightness persists and we see any additional supply shocks, whether from mine disruption, geopolitical events, or further inventory drains, $90 to $100 becomes the target range. At $100, silver would still be below its inflation adjusted 1980 peak, which was around $150 in today's money. So even if at 100 we're not in bubble territory, we're in repricing territory. The market is correcting decades of undervaluation. In the longer term, if the structural supply deficit continues for another year or two, if industrial demand from solar EVs and AI infrastructure keeps growing, and if investment demand accelerates as more people recognize silver's monetary properties, then we're looking at a potential move toward $50 to $200 over the next few years. That's not hyperbole, that's math. If industrial demand alone consumes 600 to 700 million ounces per year, and mine supply is only 850 million, the gap has to be filled by either recycling, which is limited, or by higher prices rationing demand. And if investment demand, ETF inflows, retail buying, adds another 100 to 200 million ounces demand on top of industrial, then you're looking at a market that structurally short by 300 to 400 million ounces annually. The only way that resolves is with a massive price increase that either incentivizes new supply, which takes years, or destroys demand, which means bankrupting industries. Neither is happening quickly, so prices have to go higher, much higher. Now, here's the part that's uncomfortable to talk about, but it's necessary. Risk, because no market moves in one direction forever. Silver is volatile. It always has been. In 2011, it peaked at $48, then crashed at $26 within weeks. In 2020, it surged to 29, then pulled back to 22. Even in this current rally, there have been sharp corrections. Silver dropped 10% in October. It dropped 8% in early December. These pullbacks are normal. They're healthy. They shake out weak hands. They reset technical indicators. They provide better entry points for new buyers. If you're watching silver at 69 or 70 or 73 and you're thinking about buying, understand that it could easily pull back to 65 or 62 before resuming higher. That's not a reason to avoid it. That's just volatility. But it's something you need to be prepared for mentally and financially. If you're buying physical silver, you're buying for the long term. You're buying because you believe the structural story, deficits, industrial demand, monetary hedging. You're not buying to trade it for a quick 5%. If you're buying paper, silver, futures, options, ETFs, you're taking on leverage and risk. You can make money very faster, but you can also lose money faster. And in a volatile market, that's a real consideration. So whatever your strategy, make sure it aligns with your risk tolerance and time horizon. Now, let me bring this back to the central thesis, because everything we've discussed, the Shanghai premium, the failed smash attempt, the thin liquidity, the supply deficits, the Chinese export controls, all of it points to one conclusion. The silver market is transitioning from a paper-dominated pricing system, physical-dominated pricing system. For decades, COMEX futures set the price. Speculators, hedgers, and banks traded contracts, and the physical market followed. But in 2025, that relationship is inverting. Physical buyers in Shanghai and Mumbai and industrial centers around the world are ignoring paper prices. They're buying at premiums, they're securing supply. And as they do, the paper market is being forced to follow. That's what the Shanghai premium represents. It's not a temporary anomaly, it's a signal. The physical market is leading, and the physical market is saying that silver is worth more than 69 gold. It's worth 73, maybe more. And if you wait for COMEX to officially print 73 on a screen, you're going to be late, because by the time the paper market admits the truth, physical premiums will have already widened further. Coin dealers will be charging $75, $107, $80 per ounce for actual metal, and you'll be competing with millions of other buyers trying to secure supply at the same time. So what does this mean for you? It means the opportunity is now, not next month, not when silver hits 80 or 100, and it's on the front page of every financial website. Now, when the evidence is clear, but the crowd hasn't reacted yet, when the Shanghai premium is widening, but most people don't even know what that means, when industrial buyers are hitting the bid, but retail investors are still on the sidelines, this is the window, and it's not going to stay open forever. Because once this transition becomes obvious, once the paper market breaks or COMEX has a delivery failure, or a major institution publicly declares a physical shortage, the stampede begins. And in a market as small as silver, stampede means prices gap up vertically. You won't be able to buy at 70 or 75. You'll be buying at 90 or 100 or wherever the next willing seller appears. And by that point, the easy gains are gone. The risk reward is flipped. You're buying at the top of a surge instead of the beginning. Now, I want to be very clear about something. I'm not a financial advisor. This is not investment advice. I'm not telling you to buy silver or any other asset. What I'm doing is presenting evidence, data from exchanges, from industry groups, from official reports. I'm connecting dots. I'm showing you a pattern, and I'm explaining why that pattern suggests a significant repricing is underway. What you do with that information is your decision. You could buy physical silver, bars, coins from a reputable dealer. You could buy shares in a silver ETF like SLV. Though be aware that ETFs come with counterparty risk and may not perform exactly like physical metal. You could buy shares in silver mining companies which offer leverage to the silver price, but also come with operational and management risks. Or you could do nothing. You could wait and watch. And if I'm wrong, if the Shanghai premium closes, if inventory stabilize, if prices fall back to $50 to $60, then you avoided a loss. But if I'm right, if everything we've discussed plays out, if silver breaks 70, then 80, then 100, you'll have missed one of the clearest asymmetric opportunities in the commodities market. And unlike stocks or bonds or real estate, you can't print more silver. You can't create it out of thin air. It's finite. And when a finite resource faces surging demand and declining supply, there's only one possible outcome. Price goes up a lot. So let me leave you with this final thought. The Shanghai silver price hit 71.54 yesterday. That's a fact. New York closed at 60, 90, 50, 70, 70, 70, 70, 70. The gap is 253. That's a fact. This gap has persisted and widened for weeks, despite every economic incentive for arbitrageurs to close it. That's a fact. COMEX inventories are declining. Shanghai inventories are declining. Rates are 39%. Industrial demand is at record highs. All facts. Now, you can interpret these facts however you want. You can dismiss them as noise. You can assume the market will self-correct and everything will normalize. Or you can recognize what's actually happening. A structural shortage is unfolding in real time. The physical market is pulling away from the paper market. And the price that's real, the price that actual buyers are paying for actual metal is not $69. It's $73, maybe higher. The Western paper market just hasn't admitted it yet, but it will. Because in the end, physics beats paper. Reality beats narrative. And when the metal runs out, the price is whatever the last buyer is willing to pay. Right now in Shanghai, the price is 71.54. Tomorrow it might be 73. Next week, 75. Next month, who knows? The only question that matters is this. Are you going to wait until everyone else figures it out? Or are you going to act while the window is still open? If this video just connected dots you've been sensing but couldn't articulate, hit the like button right now. If you think someone in your life needs to see this analysis, share it with them. And if you want to understand what happens next, because this story is just beginning, subscribe to this channel. The next 6 months are going to redefine what silver means in the global economy. Make sure you're on the right side of that transition.